Premium growth in the U.S. non-standard auto insurance market has jumped so far in 2021, representing a notable departure from recent history. I'm John Weber for AM Best TV. Here to talk about the market is David Blades, Associate Director, Industry Research and Analytics at AM Best. And David, with pandemic effects gradually diminishing, will the non-standard auto segment see a bounce in results, or does a return to normalcy also return long-standing issues?
Based on the results that we've seen so far in 2021, let me start there. I believe the one thing that we will continue to see is an uptick in premium growth. If you go back to 2020, due to the post-pandemic economic turmoil and the increase in unemployment, many of the affected people, those that are living closer to the margin, let's say, those people sometimes had a decision to make in terms of maybe canceling their auto insurance or allowing their insurance to lapse, especially with the shelter-in-place edicts that were in effect countrywide. So once the economy started bouncing back, you know, many of those people found that they could no longer claim to have the continuous auto coverage in place, and therefore they had to access the non-standard auto market. So I think we're still seeing that play out. I think premium growth alone is not going to be enough to buoy or bolster results over time. I think ultimately it's going to come back to the fundamental price adequacy that's needed for the inherently higher hazard risks that non-standard auto insurers insure. That's really where their bread and butter is going to be made from a profitability standpoint. So I think that's really where they're going to have to continue honing in and making the better decisions in order to make the results continue improving as we've seen over the last few years.
David, how do you see the year playing out in terms of inflation?
Well, yes, I do think inflation will probably have somewhat of a negative effect on auto repair costs. I think inflation from that perspective, and also inflation, depending on how it's going with regards to just overall medical costs. So from a bodily injury standpoint, I can see that having a negative effect on from a results perspective, but at least put pressure on results, and definitely the cost to repair autos and especially those more technologically advanced automobiles that are built, the more recently built automobiles. I think that's putting additional pressure on property damage. So I think inflationary pressures are something that we're definitely watching in terms of the impact that that's going to have.
Interestingly, in 2020, the spiking unemployment rate didn't appear to have a severe impact on premium. Why do you think that was?
Well, all right, so I honestly think what we saw was two different things at play. You just mentioned the unemployment rate, and that would be expected, obviously, to maybe obviously have a diminishing effect on overall premium. But coming into 2020, what was also in effect from a market standpoint was there had been significant upward price momentum in the personal auto market, and even more specific to non-standard auto market. So I think the diminishing effects from unemployment were actually more offset by the specific upward premium momentum that non-standard auto insurers were really pushing for and were really taking advantage of from a premium standpoint. So I think that's where we saw a little bit of the balance from that standpoint. And again, I think that helped to offset what you would have thought would have been more of a declining impact from unemployment and the effect that that would have on non-standard auto premium.
Now, the non-standard market's results typically lag behind those of private passenger results. David, is that ultimately just indicative of the type of market exposures, and can they narrow the gap?
Honestly, I think, again, by the very nature of insuring drivers that present moderate to high hazards, the results for non-standard auto insurers are always likely to lag at least a little bit behind the private passenger auto, standard auto market, right? Um, and a couple of reasons. The risks of claims fraud that's associated with non-standard auto policyholders has been proven over time to be higher than the risk of fraud from standard auto policyholders. So I think that's one factor and one reason why loss adjustment expenses typically have always been higher for the non-standard auto market. So I think that also there's an elevated underwriting expenses that are associated with servicing specific types of insureds that are in the non-standard auto market. So I think when you look at it, that you have sort of an elevated claims in terms of the risk of claim fraud, and just the fact that the non-standard auto insurers are insuring riskier drivers, and then the fact that the expense load in terms of the underwriting expenses that are associated with um, underwriting non-standard auto insurers, again, the fact that that's also elevated, I think there's always going to be somewhat of a of a lag, or somewhat of a differentiation between the results for non-standard auto riders and standard auto riders. With that said, I think the better that non-standard auto insurers really hone in on price adequacy, and that's more of an impact than being selected from a risk selection standpoint. Because again, inherently you're insuring riskier drivers. But I think the better that they do in terms of really honing in on price adequacy on an account by account basis, I think that can allow them in the best years to really tighten that gap. But I think there'll always be somewhat of a lag from a result standpoint.
Thanks, David.
No problem. Thank you.
That was David Blades, Associate Director, Research and Analytics. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.